post the Diwali effect in November, you had some retracement. So the fact that December has been much worse than November suggests pretty significant weakness in consumption.
I only hope that everything should be done to increase the consumer faith in the society and not to have a worry about tomorrow where everybody starts saving money and not investing and spending money. It's not good for the economy.
Come budget time or even before budget time, we'll make some announcements which must be significantly helping the growth of the economy, and I don't think we have time to waste on that. I think the steps or the measures or whatever we do should not in any manner affect the economic growth at all.
Hopes of an economic recovery were dashed as the December index for industrial production plummeted into negative territory, dragged down by poor manufacturing and slowing consumption, till date one of the key pillars of the economy. To further add to the gloom, consumer price inflation climbed to 10.79% in January, something that only adds to the RBI's challenges as it deals with growing complications of the growth versus inflation battle. Are we then heading into a bit of a macroeconomic conundrum, and is the light at the end of the tunnel nowhere in sight just as yet? That's our debate tonight on We Mean Business, and joining me on the show, Mr. Siddharth Birla, the Vice President of FICCI, and Chandrajit Banerjee, Director General of CII, on a link from New Delhi. Dr. Brinda Jagidar, Head of Economic Research from the State Bank of India, joins us on a link from Mumbai. Mr. Siddharth Roy, Economic Advisor to the Tata Group, will join us in our Mumbai studios. And Nalan Kohli, the National Executive Member of the BJP, joins in from our New Delhi studios. But before we begin our debate, a detailed analysis of today's IIP numbers from our financial policy editor, Ira Dugal.
The economic data remains fairly gloomy and actually remains quite contradictory and quite complex. Let's start with the industrial output numbers that came in today, and we'll segue into the consumer inflation numbers. But the industrial output numbers are telling you a story of continued sluggishness, and it's tough to actually even say that we've hit a bottom as far as industrial output is concerned. What you got on December IIP was negative 0.6%, so it's a contraction of 0.6%. Expectation was an expansion of about 1% odd, so you actually underperformed on those expectations. You also had a downward revision coming in, so the month of November, you had industrial output being revised down to negative 0.8%. So again, both of those numbers are not particularly encouraging. Let's look at the breakup, and the breakup actually has a lot to tell you. Not so much on the sectoral point, but sectorally, manufacturing actually came down by 0.7%. So that crucial part of the economy remains very much under pressure. Mining saw a downtick of 4%, but there was a base effect that had to be built in, so you have to keep that in mind. But mining activity is at a near standstill in any case. Electricity remains relatively strong, 5%, 5.2% uptick coming in the electricity sector. The real problem comes in on what happened on consumption this time, and if this is something that's going to turn into a trend, then we have to be worried, quite worried. Consumer goods saw a contraction of 4.2%, and within that, consumer durables were down 8.2%. Consumer non-durables were down 1.4%. In fact, going into the data, a lot of economists were expecting consumer non-durables to be very weak because there was a base effect. That's not what actually bit the data. What bit the data was consumer durables. Explanations doing the round: maybe there was an inventory build-up during Diwali month, and post-Diwali months you had a drop in production. That could be one explanation, but we don't know for sure, and we don't know how the next few months will shape up. So consumer durables is something you want to watch very, very carefully. The other components of IIP telling you a slightly mixed story. Capital goods was actually not that bad. Yes, it was negative 0.9, but not really that bad. In any case, on the investment side, things remain quite sluggish. Intermediate goods are more or less flattish. Basic goods were okay with about 2.6% growth. So the IIP numbers themselves are telling you a story of continued sluggishness, and like I said, tough to tell whether bottom has indeed been reached. What you also got today was the consumer price inflation numbers, and that's what is highlighting the challenge in the economy, because consumer price inflation continues to be very high, in fact rising. 10.79% was the combined CPI. You break that down into rural and urban CPI, and both of those components have climbed. Rural CPI at 10.88%, urban CPI at 10.73%. There is still a large component of food prices, but you know that you can't ignore consumer consumer inflation, even though wholesale inflation is setting your policy. But from a policy standpoint, what does this mean? Well, it means that the RBI probably will lean towards another rate cut in March. 25 basis points is being talked about, especially if you look at the consumer numbers and you look at the CSO's estimates of GDP. Both of those will argue in favor of a rate action. On the flip side, there is the high CPI number and there is the near 6% CAD, which we are expecting. That's the current account deficit that we're expecting in the third quarter. Both of those will argue against a rate action. So once again, it will be a very close judgment call.
Sequentially, the December looks much worse. So quite clearly, it was just a short blip, which we saw in October, which was clearly a ramp up for the preparation of the festive month. So consumption, will likely remain weak. And if I look at our numbers, we would be happy to see even a 1.2% growth for the full year. That would be probably on a more optimistic side at this point in time.
Post the Diwali effect in November, you had some retracement. So the fact that December has been much worse than November suggests pretty significant weakness in consumption. So I think this month it's not the capital goods sector. Capital goods, from what you mentioned, has just degrown sequentially by less than 1%, which is not bad given the larger volatility of the sector. The headline number suggests a 1.5% sequential contraction between November and December, which now makes it pretty clear that the quarterly growth for this quarter for overall GDP will very likely be well below 5%.
We are a consumption-oriented society, at least the way our GDP had been growing in the past maybe 1 decade. But the consumption coming down to a negative number is very alarming. I wouldn't mind, like, say, maybe 2 months back, we've spoken about a double-digit consumer growth happening to a single digit. Okay, that is indicative, and I thought things are going to be turning around. But once it comes down to a negative number, where are we heading as a country? Because we are not an exporting economy like China, where, okay, we'll manufacture and export out of the country. We are manufacturing predominantly for the country and part exporting. So it's a concern. I only hope that everything should be done to increase the consumer faith in the society and not to have a worry about tomorrow where everybody starts saving money and not investing and spending money. It's not good for an economy.